It's a different approach where we've been talking about tax topics from a theoretical point of view. Here's an opportunity to use a fictional case study and see how we not just bring concepts to life, but how we coordinate and work together as a team to service that client who is exposed to multiple jurisdictions. We're looking at a fictional case study with a family that's moving from the Philippines to Indonesia to Singapore and then to the US. So let's move to the third stage of their journey. So the Filipina discovers that she is an accidental American because, of course, the Philippines probably has the highest concentration of US citizens in Asia because of certain historical reasons. In fact, the United States has an office that processes Social Security. There's a Veteran Affairs, a lot of operations that are interesting from a tax point of view for its citizens that reside outside of the US. There's a lot of activity that takes place in the Philippines because of those factors. So it's not surprising that this Filipina, this well-to-do Filipina, is also US exposed. The thing is that she may be, just like most US taxpayers who reside outside of the US, she may not have been aware of her responsibilities to pay taxes, even though she's not physically in the US. So there are some options to bring her back on track, assuming her non-compliance really is innocent. She really was what we call an accidental American, someone who may have inherited her U.S. status from one or both parents and never lived in the U.S., was never really aware of the responsibilities that came with that. Then she may benefit from an amnesty program called the Streamlined Compliance Procedures. So it requires that she backfile just for the last 3 years, for which the due date has already passed. She's probably in her 30s by now, but there's no requirement to go all the way back. The statute of limitations is 3 years, just go back 3 years. And just like Indonesia, there is foreign asset declaration, but whereas Indonesia requires you to list all your assets, not just your financial assets, but physical assets as well outside of Indonesia. The US foreign asset reporting regime only requires that you, generally speaking, list foreign financial assets or foreign income producing assets basically need to be declared in the account. So the most common foreign asset reporting regime within that structure is the FBAR, the Foreign Bank Account Report. The statute of limitations with that is around 6 years. So you look at the last 6 years for which your due date has already passed. So the FBARs, the Foreign Bank Account Report, goes back 6 years. The tax returns go back 3 years, as we said. And that is submitted together with a statement explaining the non-compliance, and generally speaking, if there are no complications, then the IRS is fine with that. You're okay to move. So let's assume they've retained immigration counsel, and from an immigration point of view, there are no issues. They've resolved the issues with getting husband and kids on the right path to moving to the US. So coming back to Singapore, what steps are needed, if any, to properly exit the tax system in Singapore? Let's assume that they've gone with one of the family office structures or one of the family office regimes. So it doesn't really require, it will continue to operate even in their absence. So they leave Singapore, but they have the CEO of the family office, they have the compliance regime, they're following all the rules. So they can continue to have their assets managed from Singapore in their absence. And depending on the nature of that family office structure, for example, if it's an irrevocable trust, or what we call in the US a non-grantor trust structure, and it's been put in place the requisite number of years in advance of a move to the US, this could be quite interesting from a US point of view, because the US, like Indonesia, like the Philippines, taxes you on your worldwide income. So with the right family office structure in Singapore, they can legally avoid being taxed on the investment income that's arising through their investments in Asia through the family office. Anything that's distributed to them, obviously they declare, they pay tax on it, but the income that would accumulate within the family office structure can be structured legally in a way that is out of reach of the US tax system. So that could be quite interesting, and continuing to leverage Singapore even though the family has moved to the US. So we've seen this family through its journey from newlyweds in the Philippines to moving together for the first time living in Jakarta. And then as they've We've grown as a family, welcomed kids. We've seen them move to Singapore. We've guided them and instructed them as a Moores Rowland team through that stage, and finally to the U.S.